Welcome to The Explainer. Today, we are diving deep into the massive Q1 2026 earnings report from insurtech company Slide Insurance, trading under the ticker SLDE. Listen, if you follow the property and casualty insurance space at all, you know exactly how volatile it's been in coastal markets recently. But Slide? Well, they've just posted numbers that absolutely stand out from the pack. We're going to unpack exactly how they achieved this record-breaking quarter, the specific technology that's driving their underwriting, and what their pretty aggressive expansion means for the future.
Okay, here's our roadmap for the explainer today. We'll start with the Q1 surge, break down their tech advantage, examine this massive reinsurance fortress they've built, look at their capital return strategy, and finally, map out their expansion beyond Florida.
All right, Section 1, the Q1 2026 surge. Let's get right into these top and bottom line growth numbers that basically had the entire market talking. 50%. Just let that sink in for a second. That is Slide's annualized return on equity for the first quarter. To put that into perspective for you, in the insurance sector, a 15 to 20% ROE is typically considered phenomenal. So hitting an annualized 50%, that establishes the incredibly high stakes and the explosive capital efficiency that Slide is operating with right out of the gate in 2026. This isn't just growth, guys. This is highly profitable, incredibly efficient growth.
Looking right at the press release highlights, you can see gross written premiums literally skyrocketed by 49.1% year over year, hitting $414.8 million. And their net income, that jumped 50.8%. So they're scaling their revenue and their bottom line profit in tandem, which is exactly what you want to see. Plus, they grew their total policies in force by 46%, up to over 508,000 policies.
And you can see visually how this translates to massive scaling and profitability. Q1 net income essentially jumped from $92.5 million in 2025 to a record $139.5 million this quarter. That translates to $1.02 in diluted earnings per share. This kind of jump is absolute proof that their operating leverage is kicking in beautifully as they scale up the business. So how are they actually pulling this off in a market where so many others have struggled? Let's move to Section 2, the tech and underwriting advantage.
Before we throw more numbers at you, let's quickly demystify a really crucial piece of industry jargon, the combined ratio. Basically, this is just the sum of an insurer's loss and expense ratios. It's kind of the ultimate scorecard for an insurance company. Anything below 100% means the company's making an underwriting profit before they even factor in investment income. So the lower the number, the better off they are.
Now, what is super interesting here is the documented improvement in their combined ratio. Back in Q1 of 2025, it was already at an impressive 58.9%, but this quarter, they drove it down even further to 55.5%. Their loss ratio improved to 30.4%, and their expense ratio dropped to 25.1%. This proves beyond a shadow of a doubt that their operational leverage is working. They're writing more premiums without proportionally increasing their expenses, or, more importantly, taking on bad risks. A really key part of their Florida strategy involves something called Citizens Takeouts. Basically, Florida has a state-run insurer of last resort known as Citizens Property Insurance Corporation. To reduce the state's overall risk, they actually allow private insurers to assume or take out these policies. In Q1 alone, Slide strategically acquired over 28,000 of these policies, which represents $92.3 million in annualized gross premiums.
But listen, they aren't just blindly taking on these policies. This quote from CEO Bruce Lucas really hits the nail on the head regarding their secret weapon. On the earnings call, he stated, "We underwrite with a $6 trillion total insured base underwriting set. Procast has been proven 100 times over now." Procast is their proprietary tech system. It gives them this distinct data advantage, allowing them to accurately forecast reinsurance costs and essentially cherry-pick only the most profitable policies to bring into their portfolio.
Of course, writing policies in catastrophe-prone areas requires some massive protection. Let's move into our third section, the reinsurance fortress, and look at how Slide protects its balance sheet. To really get this, we need to understand what a reinsurance tower is. Think of it as, well, insurance for the insurance company. It's a structured set of layers of coverage that an insurer buys to protect themselves against massive, catastrophic loss events. Like a major Category 4 hurricane making landfall in a highly populated area.
Building on that idea, you can see a truly massive capacity jump in their new 2026 to 2027 reinsurance program. Look at this. Their total aggregate limit leaped from $3.3 billion to an astounding $5.463 billion. First event coverage saw a huge jump too, expanding to nearly $4 billion. They've essentially scaled their protection perfectly in tandem with that rapid premium growth we talked about earlier.
And they didn't just buy more coverage, they completely diversified where it's coming from. They added 12 new reinsurance markets. They upped their multi-year purple re-catastrophe bond to $780 million. But here is the most important part. Their first event retention, which is basically the amount of loss they have to pay out of pocket before reinsurance even kicks in, is conservatively capped at no more than 25% of their estimated pre-tax earnings. Plus, every single reinsurer in this tower is rated AM Best A or better. So the credit quality backing up this fortress is absolutely top tier. So, with record profits and a completely fortified balance sheet, what exactly is management doing with their growing pile of excess cash? That brings us right to Section 4, aggressive capital return. Slide went public back in June of 2025. At the time, that IPO diluted existing common shareholders by 13%. But look at where it stands right now, just 3%. How do you achieve a 10% reduction in dilution in less than a year? The answer is a massive, incredibly aggressive stock buyback strategy. The real takeaway here is just how aggressively the board is authorizing these buybacks. Since inception, they've repurchased 13.3 million shares, effectively returning $230.9 million to shareholders at an average price of $17.30. And that is incredibly close to their $17 IPO price. The CEO made it crystal clear on the earnings call they firmly believe the market is severely undervaluing their massive outperformance. Because they're generating so much free cash flow, they finished a $120 million program, instantly launched a $125 million program in March, and then turned around and authorized yet another $100 million program in April. It's nonstop. But Slide isn't just buying back stock, they're actively setting the stage for future growth. Let's transition to our final segment, expanding beyond Florida. Now, Florida has obviously been a total goldmine for their tech-driven model, but true long-term stability requires geographic diversification. The big news here is California. Management noted that the launch of their excess and surplus lines program out there is imminent. Distribution is fully in place, and they're projecting $50 to $100 million in new premium this year alone. They're also expanding into New York and New Jersey to capitalize on capacity shortfalls and leverage Northeast reinsurance synergies, all while South Carolina continues to deliver really robust voluntary sales.
And so that leaves us with a pretty fascinating question to ponder. We've just seen Slide post a 55.5% combined ratio, build a $5.4 billion reinsurance fortress, and aggressively buy back their own stock, all while plotting out this multi-state expansion. As this agile tech-first insurtech takes its proven Procast model out of Florida and into massive markets like California and New York, how will legacy insurers who are burdened by older tech and heavy legacy costs possibly compete with that? It's a storyline that everyone following the insurance sector absolutely needs to watch closely. Thank you so much for joining me for this explainer. We'll see you next time.